We're here to discuss the weekly real estate market conditions here in Silicon Valley for the week ending May 23rd at 11:59 p.m. These are the key chapters and the graphics that go along with them, so you can jump to the chapter you like the most. The handout is live. If you need details on how to get the 68-page PDF slide presentation, just go to chapter 12. Let's get into the first bonus slide. This is looking at just the sales over the last week. Normally, I look at things over a 5-week period of time to get rid of the statistical fluctuation you see here. What I'm trying to do is just show the current activity, looking just at the offers that have been accepted in the past 5 weeks, minus 1 day. In other words, most of my data is through midnight at 11:59. When I'm only going back 1 week, there's an awful lot of very late reports. So this one data slide is from last Friday through midnight Thursday instead of Friday. And that's so that the data is more accurate. You can see that went down a little bit from last week. We'll probably go down significantly next week because of the Memorial Day holiday. That's just a holiday effect that happens. And Easter is what's causing this bounce, because you can see Easter moves around quite a bit in the past 11 years. Basically, we've been selling about 78% of the volume, somewhere between 75 and 80% of the volume, basically all since sometime in 2023. And we continue to sell at about that rate. Here's a quick summary of my micromarket data. The green areas over here are all compared to the 10-year median. So you can see that everybody is more favoring the buyer than typical, except for Saratoga Las Gatas, which is actually favoring the sellers more than typical. They have less inventory, they have fewer sales, and they only have slightly more days unsold inventory, sort of like Cupertino. The only area doing better really doesn't count because it's Foster City Redwood Shores, and that's such a small micro market area. But all the other areas, the other 17, are all a fairly significant shade of blue. Then you can see what the DUI is now. And the reason this is important is even though we have mostly buyer's conditions, we are still a fast-paced marketplace based on the normal turnover rate of the marketplace. Marketing time is very reasonable. Most of them are 2 to 3 weeks. The price adjustments are starting to show up, but that's a very tight metric. Most of these numbers are somewhere around 1.5% reduction. But remember, only about 15% of the sellers are doing the price reduction. So that becomes a fairly large price adjustment when you realize that 85% aren't doing it. And here's the frequency. You can see you got some high single digits right around 9. There's actually a few around 5, a lot around 20 up here in Santa Clara County. San Mateo County is doing better with less price reductions. And Alameda County is a little bit higher than Santa Clara, just eyeballing it. And you have the overbidding. These are lagging indicators, which is why they're orange in time. And then the last two columns have nothing to do with indicators. They're past performance. The appreciation since 2015, and then the median, and as well as the lowest and highest expected prices in the different areas. So let's get into the normal presentation. So here's the normal first slide, slide number 2, showing the summary conditions. Inventory, you can see, is higher than it typically is. It came down this week. That's very common going into a holiday. Sellers don't come on the week before the holiday because this is the weekend that the buyers would be seeing those properties. Next week, I expect lower level of offers accepted, higher level of inventory, causing the days unsold inventory, the turnover rate, to really increase. Offers accepted, you can see you've been going between the blue line and the gray line. The gray line is where you'd expect the market to be. Blue line is the least you'd expect it to be. You can see we're currently at 78.3% of the marketplace. 13 weeks ago, we made it up to 84%. I think we actually topped off at about 93% before we came back down, and that was early this year. You got the actual raw numbers here. The raw number in the purple tends to be my current data. Then your typical is at 2,900. The robust number of offers is 3,200. And the least you expect a sluggish marketplace is 2,100. And here we are at 2,300. So you're a little bit better than a sluggish marketplace. Transactions closed. When you're seeing a difference and the transactions closed is a lower percentage than the offers accepted, that suggests that we're seeing a slightly higher transaction fail rate. Now, there's not a direct correlation because the transactions that are closing now got accepted 4 to 6 weeks ago for the large part and aren't a direct comparison. Turnover rate measured in days of unsold inventory is the seller-buyer balance, the supply-demand balance, which is important. Most areas of the country quote this in months. I believe real estate is a much more weekly cycle, so everything I do is on either days or weeks. I use days unsold inventory because the number is fairly small, typically somewhere around 30, 35, 40 for Silicon Valley. We're a little bit on the high side now at 48 days. And to say that 7.2 weeks just seems weird. So I stick with number of days and call it 48 days. You can see that we're 57% slower than we typically are because we're at 150% of normal. We started off the quarter at 116% of normal. Marketing time. This is the time that it takes 3 out of 4 sellers to sell their property. You can see that it's been gradually increasing. And earlier in the year, it came down. You can see the slope here on the typical lines coming down. That's what the purple line did, but it did it earlier than normal. It did about a half a quarter earlier. So instead of right around the end of January, it happened right around the end of December where marketing time started to improve dramatically. We're currently at 24 days. We're typically at 17 days, so we're taking a full week longer than normal. Going from 2.5 weeks to 3.5 weeks is a fairly significant increase on a percentage basis. What's really shocking is this 34%. So you were 1/3 the marketing time just a quarter ago, and now you're 1.5 times the marketing time. So you've really had a factor of 5 slowdown based on normal. And a lot of that, as I said earlier, was the timing shift. You can see how days on market climbs later in the year while we're just climbing earlier. And I don't know what's caused the shift in the time. The decrease in days on market happened about a half quarter early, and now the increasing days on market actually started a full quarter earlier than it normally does. Clearly, there's something going on, and that's been one of the only times I've seen a time shift of this magnitude since I've been collecting data in '98. Looking at price cuts, this is the seller's price adjustments. This is sort of an indication of the seller's expectations to market reality. In other words, most sellers, when they put their house on the market, they do research, they try to take into consideration current market conditions, and they price their house where they think they'll attract the offers. If they have to do price reductions to attract that offer, their expectations misread the market reality. So it's sort of seeing how the two are aligned. And you can see that just 13 weeks ago, we were perfectly aligned right on top of the typical line. We were at 92% of where you're supposed to be or where you'd expect to be. Now, just 13 weeks later, we're at 224% of where you'd expect it to be. More than twice as large of price adjustments. And you can see it's typically only just under 1/2%, and now you're just over 1%. So that's the reason you're more than doubling the price reductions. And then the last one is on here is more of an fun indicator because obviously overbids, I don't know that data until the escrows close. That introduces a 4 to 6 week lag time. So it's definitely not a leading indicator or a predictor of what the market's doing, but an indication of where the market has been. You can see that we started off a quarter ago, 14 weeks ago, well, 13 weeks ago, not including this week. We were 6.7% overbid for average overbid. Typical average overbid is only 4.2. So that's why the purple line is above the typical. And now we're below the typical line because we're only getting 6.4% overbids, which are still respectable. But we're typically at this time of the year, based on the last 10 years, getting 7.8%, almost 8% overbids. Here's now looking at the 3 key indicators for long term. You're starting off with inventory in the purple. You're up here at almost 130% of normal. You can see that the only time we had a higher percent of normal was right here at the end of 2018 and 2019. So we clearly have more inventory than we're used to based on the past 10 years. Then moving on to offers accepted, that's the gold line. And if you come back, you can see how we've been basically at this level. Actually, it looks like we got down there sometime late in 2022. So since the fourth quarter of 2022, we've been floating somewhere in this 70 to 80 percentile range, spending a lot of it right around 75, 80%. So we're obviously missing. That's clearly some of the lowest volume we've had. We were at basically 100% going into the pandemic. Coming out of the pandemic, we sold more transactions than we normally did. And one of the media articles I picked up this week, and there's been a lot more negative media recently, was they were comparing the volume of sales compared to something in 2021, which is where we were artificially high after the pandemic. And they were trying to put the blame on this decrease from this higher inflated level down to this current level on the Fed's increasing the interest rates. Well, the Feds didn't increase interest rates at that point in time, but this was clearly a surplus of where you'd expect the market to be. So the decrease from where you'd expect it to be if we didn't have COVID would have been less dramatic. And I also argue that some of these transactions that we're missing now are the transactions that happened back here. To me, it's not as bad as that article made it out to be, but that's what happens. When the market's rosy, the media tends to be overly rosy, and when the market's down, it tends to be overly down. I try to provide balance. I also try to provide it more updated because they're talking about transactions that are closed, That adds in a 4 to 5 week period right there. They're also looking at only calendar month data, and it also takes them almost a whole month to produce that data. I'm turning around the data in the same day, doing it every single week and doing a moving period. So every week you see the changes. And that's some of the big advantages of this data set that I try to present weekly for you. And the last data point is the days unsold inventory, the gray line, which is the turnover rate of the marketplace. And you can see that we're basically at the record high number, except for a short period of time during the COVID shelter in place where we couldn't even show properties. Clearly, the supply demand balance is not where it typically is. Right now, it's favoring the buyers overall, but you also have to look at the market conditions in each different micro market area, because this is Silicon Valley, Santa Clara, San Mateo, and Alameda counties all combined. Now we're going to look at each one individually. This is active inventory. You can see that last year, we ended the year with a shortage of inventory. We were below the typical inventory all of 2024, all of 2023. We had a real shortage. You have to get back to 2022 in order to have reasonably normal levels of inventory. And that was only the second half after we had the price correction that started, in my opinion, right around February, middle of February, Valentine's Day of 2022. Now you can see that you went from a shortage of inventory on January 1st of 2025, so just 45 days ago, and we went straight up. Look how quickly we went from being red to typical gray, and then from gray up to blue, and then from blue above blue. And again, the dip down this week is the holiday. I expect next week right back up because there's typically a flood of new sellers coming on the market the week after the holiday. Here is on a percentage basis. So inventory is not a complete record high. You can see on a percentage basis, there was more inventory at the last part of 2018 and early in 2019, but clearly we've had more inventory than the vast majority of the past 10 years. Here's looking at the number of offers. You can see that we've been below the gray line, which is where you'd expect. You can also, when you're looking at Silicon Valley, see this U shape, which happened right after the president announced his tariffs being in there. And now you're going back up. And, that might sound like we're okay, but remember, we should be going back up from this period up here. So you should be up here. So you're still missing more transactions than you would have most likely had that program not been announced. But we can't live in wannabes or anything like that. Right now, we're selling more than the least amount of offers that you'd expect. And also, it's interesting that the different counties that make up Santa Clara County are acting differently. San Mateo County, if I remember correctly, didn't have any impact at all. Santa Clara County had the vast majority of the impact, and Alameda County had a lighter version of what Santa Clara did. So it's important to pay attention. This is compared to the 10-year median. So you can see right now we're selling about 78%. And you can see how a lot of that time frame for the last 2.5 years, we've been basically in the 70 to 80 with that slight increase up to almost 90. I guess we didn't quite hit 90%. We got real close to 90% just before the end of first quarter. So we've been missing at least 10% of the transactions ever since, well, probably could come back here and call it since the beginning of second quarter of 2022. There was little time we were there, but we've been missing 10%, and most of that time we've been missing 20% or more of the number of transactions. So clearly less activity than we would normally expect. Here's your days unsold inventory. This is the seller-buyer ratio, supply-demand ratio, depending on how you feel comfortable talking about it. You can see that we started off the year tracing the blue line, and then we pulled away. And this is basically back to that Valentine's Day, but Valentine's Day of 2025, and we slowed down. And, clearly this was before the tariffs were announced. So how much of this is tariffs announcement? How much of it's the stock market reaction to tariffs? That's I just report on what the market's doing and not why it's doing it. Was it interest rates? Was it unemployment rate? Was it the stock market? Was it tariffs? I don't care. What I assume is the whole of the marketplace out there is smarter than any one individual. And by analyzing what the marketplace is doing, I can make better decisions. So you can see we've been improving the last couple of weeks, but we're still quite a bit slower than you'd expect. The turnover rate is longer than you would expect it to take. Here's on a percentage basis. And when you look at it on a percentage basis, again, like we have a record slow market, except for a very narrow period of time in 2020 when we were shelter in place and couldn't show properties. I'm not going to even mention this peak here of like one data point, but you can see we made it up here several weeks ago, and we've been fluctuating around this record high, which is a record slow turnover rate. It's basically 55, 58% slower than it normally is. Here's marketing time. It's an easier concept to understand. Just how long is it taking 3 out of 4 sellers to sell? And right now it's taking them 24 days for 3 out of every 4 sellers to sell their property. Typically, we're going to be vertically straight down. So typically you're sometime right around 17 days, I think the number was, because the typical's down here. So 17 days. And in a hot marketplace, you're down at 12 days. Clearly, we're slower than we are. You can see that there's an annual cycle that's much slower at the end of every year. But on a percentage basis, again, we're sort of in record territory. Sellers are taking longer than they typically are. Now, it's not as absolute. You got the 2020 slowdown. You've got the 2018 and 2019 slowdown at the end and beginning of the year. And you got a little period of time right around 2022, 2023 change where you're at the same level, more or less. So you're basically at record long marketing times right now for the past 10 years. Here's the sellers that are taking the largest 10% reduction. So I ignore 90%. I look at what the 90th percentile the seller does. The seller, and that's the 90th percentile seller is the seller that's taking the 10% largest price adjustment. 1 out of every 10 sellers, how large is his price reduction? And his price reduction is basically 13%, because here's your 100%, which would be a 0% reduction. And you can see we're down here at 87%. That would be a 13% price reduction, and significantly slower than normal. And again, you can sort of see this time shift where the least amount of reductions happen halfway through first quarter, where normally the least amount of price reductions happens halfway through second quarter. Here's on a percentage basis, larger numbers right after the price correction in 2022. So the latter part half of 2022 and the first part of 2023, we were even slower than we are, or taking larger price adjustments than we are now. But again, the same order of magnitude, and we're fluctuating quite a bit, anywhere from basically 40% to 60% more reduction than typical. Here's the seller's ask price average. So this is on here just to show you, that I'm not playing games. You can see that the peak happened right around middle of first quarter. Peak normally happens sometime early in second quarter, so slightly different than the 10 percentile. But here the price adjustment is only about 1.1%. And that's because now I'm including everybody. I'm looking at the average, but still greater than it normally is on the gray line, more than it is in a slow marketplace where sellers are taking the largest price adjustments. On a price adjustment on a percentage basis, you can see that 2023, beginning of the year and the end of 2022, we were taking bigger price adjustments, and early in 2019, we were taking bigger adjustments. But we're overall, other than maybe a total of 1 year out of the past 10 years, we're taking larger price adjustments. Here's the frequency of price reductions. So how common is it? Here you can see the data improved dramatically, where we were taking fewer price adjustments early in first quarter. Halfway through first quarter, right around Valentine's Day, we started taking larger price adjustments, and we quickly went from typical, the gray line, up to cool, which is the blue line, the most you'd expect. And we're continuing to be above that blue line. So we're taking more frequent price adjustments than you would expect. Here's the frequency. So you can see that you're lower than we were again in that same 2023 timeframe at the end of the year and early in 2019, but you're close to record levels. I mean, look at the change. You went from 60% of normal to 160% of normal in rough terms in just a couple quarters, actually in just over 1 quarter, because this is halfway through first quarter, Valentine's Day roughly, and we're not much past middle of May. So basically in about 14, 15 weeks, you went from, we'll do it a little bit more accurately, something like 65% of your price reductions, the frequency, so they were missing a third, to now we have almost 2/3 more than we should. So you've more than essentially gone up 100% of your increase. Your frequency of increase has increased 100% in just 13 weeks. Here's the median magnitude. The previous was average. So your median overbid is about 3.5% for Silicon Valley. That's below the 5.5% that you would expect to see up here, the median for typical. Here is the amount of overbidding compared to normal. So you can see we're below normal. We're about 1.5% less overbidding than you'd expect. We peaked out at about 3%, 3.5% more overbidding than you'd expect, just around a little past Valentine's Day. And this typically has a lagging indicator. So, this would actually suggest that the market changed earlier, because here's your first quarter. So this would be April 1st. This is clearly about 4 weeks earlier than that. And then if you add 4 or 5 weeks back on top of that, that's getting back to 8, 9, 10 weeks ago, which is more the beginning of first quarter instead of the middle of first quarter. This is the frequency of overbidding. So how common is overbidding? Normally it's up here with about 75% of the sellers getting an overbid on their offer that they receive. Now we're only about 67%, about 2/3 of the sellers. So you went from 3/4 where you'd expect the sellers to be getting to 2/3 of the sellers getting. So still very respectable. Don't get me wrong, with 2/3 of the sellers getting more than their asking price, but that is down from the typical 3/4 or the expected level of 3/4 for this time based on the previous 10 years. And here you can see the amount of overbidding has been coming straight down for about the last, call that 4 weeks, and call that probably 7 weeks. So almost about somewhere around 11 weeks, plus or minus, almost a full quarter now of price overbidding decrease in frequency. We're now only at 90% of the frequency of overbidding you expect versus somewhere around 112%. Here's looking at the pricing, and this is just a rough model, but I basically have two models here. One shows a 11.4% annual price increase with compounding, because this is on log paper. And, a little bit more accurate would probably be 12.5% for the first from 2014 through 2022, and then leveled off and did about 3% since 2022. But again, it really depends on when you purchase. If you purchased up here and you sold down here, you actually sold at a loss. So you have to sort of balance the peaks that we seem to have every year along with the troughs. And a lot of that isn't necessarily property values, and that's something a lot of people don't understand. You can have market mix. If all of a sudden the people that are getting more impacted now are on the low end because the low end more dependent on loans and it's the interest rates that went up, that would tend to raise your median price without impacting individual property values, because you now have lower number of transactions on the low end, which would tend to pull that price down. So if you lose transactions on the low end, your median price is going to increase. Here's now looking at distributions. This one is on days on market. So basically you start off at the 50 percentile, and that's because down here, the data gets so close together, it's really meaningless. So everything from here down to 0 are the people that are essentially taking their property offers accepted as soon as they'll accept an offer. You come up here to something like 85%, and you get some pretty nice distributions. My data is based on the third quadrant, which is 75th percentile. And that's what we're going to be mostly talking about. That's why I did 3 out of 4 sellers. Purple line is the current data point. The dotted line down here is where we were a year ago. We clearly are slower this year on the purple line than we were on the dotted line a year ago. What we're going to do is step through, and you'll notice the dotted line immediately jumps up. There it was. And that would suggest that we expect the purple line to increase from its current cooler position. Now you're going to see a huge jump up coming up right about now. Well, no, still there. Sorry about that. There it is. There's the huge jump up. And there's the peak of the marketplace right there at December 27th. And then you go racing down, and that was the peak of the marketplace on February 21st. And I only have every other data, so I don't have the February 14th Valentine's data. And now here we are. So basically, based on the data in this particular slide, the peak marketplace, the fastest marketplace, was the week I was reporting the data on February 21st. Now, I think the actual fastest is going to turn out to be the 14th, but since I only have every other week data back at that time frame, we only have data from the 7th of February and the 21st of February. Next week, we'll have the 14th data. Basically, the concept here is you expect the marketing time to increase now to the end of the year, and then you expect it to increase rapidly. And I would expect, since I don't have a better estimator, last year's model would indicate we're going to be going slower and slower even as early as this week, and it actually started earlier, but that's okay. Here's the price reductions. This is looking at the largest price reductions, and the reason I say it's the largest, I go all the way up to the seller that's taking the largest 2.5%. I don't look at this all the way down to 0, because those are typo errors, they're flukes, things of that nature. I only go down to 17.5%, and that's because the vast majority take no price reductions once you get there. In fact, you can see, right in this week, we're basically reaching the 100% line, but a lot of your previous lines are all saying these sellers are already doing no price adjustments, so there's no reason to pack my data with zeros. And same concept as the previous slide. Here's the current data, significantly cooler than we were just last year at this time. But again, we're going to look, and I think what we're going to do is see that the dotted line goes down. Yep, there it goes down. So you'd expect the purple line to continue to fall. This is what I call the summer doldrums, where it really doesn't move around. It basically bounces from week to week to week. But what we're going to see is coming up fairly soon is right there, large price reductions. There's the bottom, which was right around the end of December. Now we're racing up. There's the peak right on February 21st. So again, I don't have data from the 14th, but it's been slowing down ever since the 21st and fairly significantly slow. So huge difference from where we peaked out this year up here on the 21st of February. Huge difference from where we were a year ago. Sellers are still taking fairly significant price adjustments, but again, they're not all significant because here at 82.5% of the sellers are doing no price adjustments at all. It's only these 17.5% of the sellers are doing a price adjustment, and the largest ones are down here around 13%. 13% is pretty significant, but and even up here where you get the first price reduction is at 3%. 3% on $1 million is, not insignificant pocket change. Here now is looking at overbidding, and again, I'll caution you that this is a lagging indicator because we need to get close to escrow data. But again, here's your last year dotted line up here. Your purple line is the current, so again, significantly less overbidding for each percentage point. And we'll step through. You can see we peaked out and we're already coming down last year, so I'd expect the purple line to continue to come down further. This is about the level where it sort of balances out for a while. And because this is a lagging indicator, it stays here until almost the end of the year. We'll see it right there, December 27th, it started going down and it peaked out at January 24th. And now it's going up and bouncing a little bit, and now it's slowing down again. So I would expect this market from this line to continue to slow down for the balance of the year, bottoming out sometime right around the end of the year. Here's the active listings. You can see active listings in all 3 counties and that make up Silicon Valley are down. That's very expected because we're going into a holiday weekend. Less sellers come on the market this weekend. Next week, I expect that number to continue its climb up. You can start seeing Alameda County is back up at the level it typically is. Santa Clara County is still a little bit short, and San Mateo County is actually at a record high level of inventory. Look, the gray line here, my 600 units, is basically higher than any time in the past. So San Mateo has record high inventory, even though it's down a little bit last week. Alameda County is back to normal. Only Santa Clara County has less inventory than what I call normal. Yes, I'm calling, you have more inventory than these years, but those were abnormally low years. Back here is what I think is more normal. Here's looking at offers accepted. You can see offers accepted sort of leveled off this week, which is a little unexpected, frankly, because typically buyers continue to buy into the holidays. So I don't know what to make of next week's data. You can see San Mateo County dipped a little bit. Alameda County rate of increase slowed down, but it was still an increase. And Santa Clara is almost completely flat. I would have expected another increase. So that may be an indication that we'll see I expect offers accepted to go down next week because of the holiday. So next week's not going to be it's going to be hard to tell anything, but coming after the second week out after the holiday, it'll be interesting to see if offers are back up or flat or down. Here's days on unsold inventory. You can see that they're all decreasing, which is an improving marketplace, but that's mostly due to the less inventory coming on the marketplace was the holiday. Alameda County has the longest days on unsold inventory up here at around 55 days, followed by San Mateo at something like 46 days, and the least is Santa Clara County at 42. This is going to be interesting later on because even though it's got the longest marketing time from days on unsold inventory, and also I think in the next slide, days on market, it's going to have the most overbidding, which is not what you'd expect. Here's the 75th percentile. So you can see the longest is Alameda County and increasing. All 3 counties are increasing. Clearly, 21 days is not an unreasonable time frame for 3 out of 4 sellers to sell. But look at how often we're below that in Silicon Valley. Even before the pandemic, we're sort of at the same level of magnitude. So here's price adjustments down. This is the seller's ask price, all very close. This is the average, right about 1% price adjustment. Remember, this is a low number because the vast majority of the sellers do no price adjustment. Alameda County is doing the most price adjustments down here at about 1.2%. San Mateo County is doing the least at about 0.9%. Moving on to the frequency of price adjustments. So you can see the most frequent price adjustments are in Alameda County, followed by Santa Clara County at 16%, And then San Mateo County doing the least amount of price reductions at only 12% of the sellers adjusting their list price. Here's the overbidding, and here you're seeing Alameda County is flat at 8% over the seller's ask price. What do I think is going on? I think Alameda County is taking those larger, more frequent price adjustments, overshooting where the market is. Basically the seller comes on, overestimates the market, tries it, doesn't get an offer, is reducing the price, gets below where the market actually is, and results in the highest overbid, because you would not expect Alameda County, the county with the longest days of unsold inventory, the longest marketing time, and the most price adjustments to be having the most overbidding. And I think it's because the sellers get frustrated and then overshoot the market, and then the buyers come in and say, hey, that's a steal, and overbid. Santa Clara County and San Mateo have much lower relative overbidding at 5% for San Mateo County and Santa Clara at 5.5%. Here's the frequency of overbidding. All three are fairly close together, especially Santa Clara and Alameda County at about 68% of the sellers, 2/3 of the sellers getting more than their asking price. San Mateo County is about 63% of the sellers getting more than they're asking. Here's the long-term appreciation. Santa Clara County has the highest appreciation rate at about 125% appreciation. San Mateo County comes in second at about 90% appreciation. And in last place, it's still a respectable 80% appreciation since the last 9 months of 2015. Here's the sell prices. San Mateo County is basically very close to the record high sale price. Santa Clara County is above the record high price, and Alameda County is more like San Mateo County. And I'm going to talk a little bit about price here on regular paper. And I don't know if anyone else saw the paper article that I saw, but they basically, we don't have the data on this slide for San Francisco, but they basically said the San Francisco Bay Area, I think, had the same price now as they did in 2018. So 2018, San Mateo County is down here. You draw a straight line over, clearly they're higher. Santa Clara County would have been down here, clearly higher, and Alameda County would have been down here somewhere, clearly higher. I think what they were confusing is just San Francisco, which has been underperforming all the other areas, and claiming San Francisco reflected the whole Bay Area. I think that was one error. I think the other thing is, even with that, I still saw, because I went back and reverse engineered what I thought they were doing, I still saw about a 15% price gain for San Francisco, the county of San Francisco, which is the city of San Francisco. And I think what they're doing is, I think they're including flats, condos, townhouses, single family homes, as well as transactions that are not sold on the MLS. They're using public records. The problem with that is you can have a lot of transactions that are third party that are not full market value. And if you had more of those in 2025 and fewer of those back in 2018, that would have your 2018 base year artificially raised and your 2025 price range artificially lowered. So my comment is just, you got to be real careful when you're reading these one-off articles. You don't know what their data set is. By coming here, you're having a consistent set of data, and I'm happy to explain any questions anyone has about my data set. And I'd actually appreciate input on what someone would like to see that I currently don't have. Here's your payments, assuming the national average for Freddie Mac, jumbo conforming, high balance conforming. But basically, the order is the same as price because they go through the same numbers. I will also say this is a real rough high estimate. The reason it's high is jumbo money is cheaper than conforming money. And you can also, most people here in Silicon Valley have other assets that they can get a banking relationship with an institution and get a lower than market interest rate on their mortgage. Here, moving on to micro market data, you can see that inventory is lower in almost every area. The only area that has a shortage of inventory is Saratoga, Los Gatos at 78% of the expected level of inventory. You can see everybody else is over 100% except for Foster City right at 100%. I only have county-wide data for Alameda County for the first 3 slides. I'm showing Silicon Valley data combined. I show each of the 3 counties and then the micro market areas underneath each of the counties. Moving on to offers accepted, again, you can see very blue. Blue offers means less number of offers accepted, and you can see these are all below 100%. The highest number I think I have on here is Cupertino at 95, except for Half Moon Bay at 100. So you have Half Moon Bay, which is sort of interesting. Finally, they've lowered their prices enough that they're getting their typical level of inventory. and then you have Cupertino, and then you have Redwood City. So basically everybody's at 100% or less of their offers accepted. So clearly a lack of offers. Here's your marketing time compared to normal. Clearly we're blue almost everywhere. So this would be a slower than normal marketplace. The highest I'm seeing is the affordable areas of San Jose, actually been the Milpitas Berryessa, 290% of normal level of inventory. So that's almost 3 times. So if they're normally selling in 15 days, they're taking 45 days to sell. So it doesn't tell you the speed of the market, but it tells you the relative speed of the marketplace. So some very slow areas in Santa Clara County, and you can see that blueness, isolated pockets in San Mateo County with the deep blue, and Alameda County is more like the bulk of Santa Clara, or at least the west side of Santa Clara, and the bulk of San Mateo County, where you're still slower than normal, but not solid blue. Here's the actual raw numbers. So even like, let's look at Milpitas, 56 days. So it's off. So normally they're somewhere around 19 days maybe, and they're almost 3 times that. So that'd be 56. So that's just about right. So typically Milpitas at this time of the year, somewhere around 19, 20 days. And this year it's 56 days. You can see Campbell is still pink in color because it's faster than 42 days. But most of these areas, we're sort of more distributed. You got some pink, the fastest areas. You got some white, the balanced areas. And then you got some blue, which are the slow areas. Here's the date marketing time. So again, the same thing. We don't have any blue on marketing time yet. And that may be an indication that I don't have the scale right, because when you look at this, I'm saying that it takes 6 weeks for sellers to sell their property would be the starting blue on here. And the highest number I'm seeing on here is about 35 days, actually 36 days. So I may have to adjust this a little bit more in the future. I'm not going to do it anytime soon, probably at the end of the year. Here's the ask price adjustments. So you can see sellers are taking larger than normal price adjustments, but they're very small. 1.7% is some of the largest numbers I'm seeing. Probably Oakland's only 1.7. So 1.8 in Saratoga Las Gatos. And maybe that's one of the reasons Saratoga Las Gatos is having reasonable activity, is because they're taking more price adjustments than the other areas. Then you go to San Mateo County, and a lot of these areas are only, fractions of 0.5% and stuff. Moving on to the frequency of overbidding. So how common is it? It's getting more common on the east, more affordable areas of the valley, areas that did extremely well after the pandemic, and it's not very common for the people on the west side, the more expensive side of the Bay or the Silicon Valley. And again, you're now having Alameda County individual micro market areas, and you can see it runs the whole realm from fairly solid red in Berkeley with only 9%, only 10% of the sellers adjusting their price, all the way up to 27% of the sellers adjusting their price in Pleasanton. Here's the overbidding lagging indicator, but still more aggressive overbidding. Balanced marketplaces from 1% reduction to 1.5% increase. And clearly Silicon Valley is typically overbidding by more than 1.5%. I think the number was closer to 4 to 5.5%, if I remember. This is the frequency of overbidding. So how common is overbidding? And you can see in Santa Clara County, you're up here around 70%. Alameda County is a little bit less, maybe 65%. And I would almost say that San Mateo County is 40 to 60%, more range in San Mateo County, which is why you go from fairly white or solidly white to fairly deep red. Here's the appreciation. This is still very clear. Your west expensive areas that were close to the job center still now have the least amount of price appreciation since 2015, where the more outlying, more affordable areas have the higher appreciation rate. Here's the sold price, and instead of following just the median number, which is this middle number lined up down here, I also sandwich it by putting in the price range you'd expect for single family home, as well as the most expensive 90 percentile. So you get a price range. So for example, Saratoga Las Gatos, from 2.4 to 5.6 million is the price range. Most homes are priced around 3.9 million. Here's that same summary chart that we went over briefly at the beginning, but you can see how blue it is when you compare to normal. So we're definitely cooler than normal, but when you look at just the raw numbers, we're actually fairly hot. So a fast-paced market, competitive marketplace, and then these are lagging indicators, so they're looking more in the rearview mirror, and then the last two columns, the price and appreciation, aren't indicators at all. Here's the level of sales, and keep in mind, even though we're the second slowest out of the last 10 years, more significantly, we're the second slowest out of the last 25 years. And one of those years is the pandemic year that I feel guilty about even comparing it to. So we basically have the third slowest year, and really, in all practical purposes, the second lowest year, and will probably be the second lowest year fairly soon, because notice how this is already up to 1900 and climbing. In 2020, if you remember, starting May 1st, we could show properties again, or maybe it was Monday, May 3rd or something like that. So this number's going to climb pretty quickly, and it only has to get up to 2300 before the current 2025 year is lower than the 2020 year. Here's the raw numbers for all three counties in Silicon Valley as well as Silicon Valley. You can look at whatever makes the most sense to you. And here's how you participate live. We've been talking about the Silicon Valley real estate market. We will be talking about the greater Bay Area, 13 counties and 5 regions. The green root URL here is how you can get to the archives YouTube channel and look at any past presentation. Here's how you get to the live presentation. You type in the green root URL in 2025, and that gets you to the meeting at 9 o'clock Saturday morning. Appreciate more participation. If you want the handout, which I actually got up early this week, is the green root URL plus the letter H for handout, the year 2025, the month 05, the date 24, and it gives you a 68-page PDF of these slides. If you know a specific episode you want to do, you type the green root URL, the year, month, date, and go directly to it. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers in single agency transactions here in Silicon Valley. I'd appreciate more subscriptions and more likes. It helps get the word out. Let's move on to the greater Bay Area, the 13 counties that make up that area and 5 regions. These are my 5 regions. We've only talked about Silicon Valley. We will talk about that, but we brought in 4 other regions, the cities, the North Bay, Central Valley, and the Central Coast. Here's inventory. Inventory is going up in all of them, except for this last week. They've all sort of flattened out. Silicon Valley is the most significant decrease in inventory. That is expected because of the holidays and the lack of inventory coming on this week. Here's the number of offers accepted. They're all going up. They're continuing to go up, which is what I would have expected to happen. You can really see the dip in Silicon Valley here. There's a little bit of a dip in the North Bay and the Central Valley, but look at San Mateo County. I mean, it basically had no dip whatsoever, and the coast is sort of an animal on itself. But if it had a dip, it's still sort of down. So I think it might be more weather related over in the Central Coast area. But it's clear here that Silicon Valley was the most hit right after the stock market. Now, was it the stock market? Was the tariff? Frankly, I don't care. I want to know what the market's doing. That's the important thing. And to realize that Silicon Valley has performed differently than the cities, differently than the Central Valley, differently than the North Bay. Here's days unsold inventory. So Silicon Valley is doing the fastest, followed by cities. Then you have the Central Valley, North Bay, and the slowest is the Central Coast at almost 100 days. So that would be something like 95 days of unsold inventory. Here's marketing time. This is time to sell 3 out of 4 sellers. You can see Silicon Valley's been climbing straight up, and it turned the first. It turned back here, Valentine's Day, when the cities was still improving, Central Valley was still improving, Central Coast was falling off the cliff as Silicon Valley was turning in the corner and starting to come up. So that's why it's important to not only understand the region you're in, the more global region, or what are other areas doing, the region you're in, and then the micro market area within the region you're in. That really helps you out in the negotiations. Here's the price reductions. You can see that cities is taking the least price reductions, very similar to Silicon Valley, but the orange is on up closer to 100%. Then you have the Central Valley and the North Bay very close together. And the area that's taking the most price adjustments is the Central Coast at just shy of 2% price adjustments. Here's the frequency of the price adjustments. So Central Valley has the most adjustments. So, up here at something like 32% of the sellers, almost a third of the sellers are doing a price adjustment. The least is the cities at something like 14%. Silicon Valley is at 16%. So you can see that, again, each area is done. Now, this has turned more together, but again, Silicon Valley looks like it was the first to start climbing. The North Bay here was still going down. Central Valley was still going down, and the Central Coast was still going down. So the timing of the different areas is definitely not aligned. Here's the magnitude of overbidding. The cities has the most overbidding. It's been basically flat right around their peak, somewhere around 9.5% overbidding. Silicon Valley's down here at 6.5%, 6.5% overbidding. And then North Bay at 2%, 1.5%, actually 1% overbidding. And then both Central Valley and the Central Coast are at or below the seller's ask price. Here's the frequency of overbidding. Highest overbidding is in the cities in Silicon Valley at somewhere around 68% overbid. The least is Central Coast at about 36% overbid. There's long-term appreciation. The two standouts are the cities doing the least, but in here you can come back and start seeing the cities. Here's my price in 2018. You come forward on a straight line, you're still below. Now, if he compared here at the very bottom to the whole year of 2018, you would have been at the same level. But that was a very small area. And again, I would argue that if you compare the same time of the year, it would have been a little bit lower in the cities because you're basically down here. So I don't understand, and I wish anyone reporting on the real estate market would say what their metric is, what their data set is, what their time period is, but that's asking for way too much. Here's Silicon Valley with the most appreciation at 200%. And the reason that's down is Santa Clara County had the highest appreciation. Alameda County, I think, had the least amount of appreciation. Here's your sold price. You can see that San Mateo County is still below its record high in 2022. Silicon Valley is right at its record high of 2022, as is the Central Coast, as is the North Bay, as is the Central Valley. So we basically peaked in 2022 and we haven't gotten back over those prices yet. And that was basically early in 2022. Here's the payments that'll be in the same order because I go through a mathematical formula. And here's the actual raw numbers. You got the active inventory now under the now column. You have that it's down from a week ago, and then you have that it's up from 5 weeks ago. So you can actually look at the raw data and how that's changed over the past 1 and 5 weeks. And with that, we're finished with the summary. Back to the charts. You can link to the chapter you find most interesting in the YouTube description below. I'm going to flip over and see if anyone's got any questions. I'm not seeing any unmuted mics. Have a great week. Take care. Bye for now.